Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants.
This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast.
All right, we're live. We're in the heat of earnings season, so we'll be doing a rapid results recap for a few stocks and then get back into some more earnings calls. All right, maybe we'll start off with some good news though. And we've got Claude's away. Claude's still down with the dreaded enemy, his one of his many enemies now, COVID. So let's see. We've got a few small caps to talk through. Fair bit of news. Maybe to start off with a bit of good news. Maybe a bit of a lighthearted one. A NASA mission to a meteorite world, whatever, 10,000 quadrillion dollars worth of nickel is 2 months away from launch. So we're getting close to launching a NASA mission to this giant space rock. If you brought that rock down to Earth and sold it at current market value, it would have 10,000 quadrillion dollars worth of nickel. It's really
I think the guys at NASA need to bone up on some basic economics, because I'd be pretty sure that the market, I don't know, call me a stickler, but supply and demand
might fall a little.
It might fall a little bit, you know.
Yeah. Got to think about this in your outlook for commodities now. No, not for a while.
They're not trying to bring it back though, right? They're just going to measure it.
I mean, no, they're just going there. Actually, funny enough, I went to the space thing a few months back, I think I mentioned, and kicking off in WA today was a space mining conference, which, I feel like at this stage is more like a raise and burn money conference, no offense to WA space miners, but I feel like they're probably not there for, 20 years or something, 30 years.
Optimistically. Well, that's the other thing. Are we running out of nickel? I don't want to think that we are.
There is a bit of a shortage. There's a lot of talk of there being a supply shortage.
A shortage in the crust of the earth, or a shortage in what we have in terms of developed capacity?
Developed capacity, yeah, for sure.
Right. So if I was going to spend $1 trillion, wouldn't I? I don't know. I just want to say cost per ton might be cheap. But when the earth crust is dry.
How do you bring it down to earth too? You've got to really, you can't just slam it into.
No, and I imagine it's extraordinarily expensive to do.
Yeah.
And so it feels like.
I think the space mining that would actually happen would be more like the moon or something, because NASA's awarding real contracts now to what's Jeff Bezos's space company. Oh, my mind's blank.
Blue Sky. What's it? Blue? No, Sky. No, I've gone blank too.
Blue Origin.
Blue Origin. I knew there was.
I think they've got a contract to build a mining apparatus, and that's probably where things would first settle. And there's an idea you can build a lot of stuff on the moon out of the regolith that the moon is made from,
but bring it back though, right? Mine it there, build it there.
Yeah, that's more for mining and building there. I guess it'd have to be some pretty special stuff for you to want to bring it back. I don't know what.
You might want the tritium. I think there's a good amount of tritium on the moon. So that kind of.
Do you know this from one of the space games that you play? Is this?
I don't mind. Actually, I think it was Elite. You could mine tritium. I don't know. Yeah, but no, it's not from that. But I do know that it is potentially. Actually, I think it has potential as fusion fuel or something.
Yeah, there was some talk about that.
Something like that.
Running fusion on the moon, etc. All right, let's jump into something more relevant to small caps. That was about all the good news we could find this week.
There's not a lot out there.
Plenty more negative stuff on China, but we can touch on that another time. I don't think we have too much more to say. All right, maybe let's kick off with Envirosuite, one that we'd covered before. I think you know it a fair bit better than me. What were the latest results like for those guys?
Yeah. They're okay. I mean, I think they probably...
So Envirosuite, environmental monitoring, right? That's still kind of their core business, is putting up sensors and offering a software package around monitoring environment for leaks and air quality and all that.
Yeah, kind of noise, vibration. They bought sort of big reverse takeover a few years back of EMS, which does airport sound monitoring and the rest of it. So it's been one of these disappointing investments, I'll gladly admit. The big news that they wanted to put forward. Well, actually, we had ARR. They had a really strong fourth quarter. So their annual recurring revenue was up 12% for the year. But we knew that because we had fourth quarter results already. So there was sort of nothing new there. I guess the thing that was new that they were sort of keen to highlight was that they were or in fact positive on an adjusted EBITDA basis, positive 500K. So for the year, they had said that they would sort of hit it on a run rate basis this year. So that was more than what the market had been told to expect. Funnily enough, shares are up on the back of the results not long after, and then it ended down, and now it's like down 6% as we record this. So it's one of these things. I think
it was up on results and then ended down. And
yeah. Now it's down further. It's actually at a low it hasn't been at for a long time. So what's there to say about it? I think my view is that there's somewhere in there's a really nice little business. And the thing that attracted it to me years ago was what they now call their industrial sort of segment, which is the stuff that they use predominantly in sort of mining operations and the rest. They just sort of got a really cool little product there. It's been growing at like near enough 20% per annum on annual recurring run rate basis for a long time. And they spent a huge amount of money, issued a huge amount of shares in buying EMS, literally 2 months before COVID hit. And so all of their airport customers got knocked for six. So that's bad luck. I mean, I won't discredit them too much on that. I do think it was a big distraction. Moving into China was a big distraction. That doesn't get talked about anymore. We've had a change of management along the way. They're moving into water technologies as well, sort of like software that helps sort of optimize plants and stuff. It's actually pretty interesting and actually a lot of potential. And the chairman sort of said that this is potentially the jewel in the crown of their product suite eventually. But I've only ever looked at that as a free kick. So it's extraordinarily low base for them at the moment. But, within it all, it's sort of like you've had the kind of growth that isn't what I think we would have expected. I'll cut them some slack for COVID and what they did to airports. Although, by the way, that's showing some real signs of life again. And if water gets a bit of traction, that'll help us as well. So, sorry, go ahead.
Yeah. So total ARR growth was what, around
12%?
12%. Yeah. Okay.
Yeah. Yep.
And a few segments a bit higher, but as you say, off a low base. The water segment grew 36%, but it's at a very low base.
I kind of feel as though they need to be around 15% minimum ARR growth. The other thing that's like the question at the moment, so I was not going to complain. Adjusted EBITDA positive, that's great. It's cool. But, is that the best metric to use? You've got to mention, management will always point you towards the metric they want you to focus on.
Yeah.
I mean, the statutory loss was $10 million here. There are very real depreciation charges in
I think it just doesn't make sense when there's real depreciation charges, right? That's the difference. It kind of makes sense sometimes when it's like there's no depreciation in the business to use EBITDA. But yeah, once you get some in there, it's not ideal.
And they're spending a lot of money on product development stuff as well. And that's all being capitalized. Yes, that's just how it's done. We can talk a bit about that when we chat about objective in a moment. And they stripped this adjusted EBITDA, so they stripped out the annualized cost savings for their restructuring efforts. I think that's not unreasonable to do. Like, what does it look like going forward? Not, we could argue that to some extent, but it's not unreasonable. But then again, there's $750K worth of share-based payments which were excluded from that as well because it's non-cash. Hang on. Actually, you put that back in and you weren't adjusted EBITDA positive, were you? To their credit, they do call out this what they call management operating cash flow, where I think it's a more realistic strip out of things and addition of things, and let's not get into the weeds, but it's still minus 3.2 million. Now, by the way, in last year, it was almost minus 10 million. So a massive improvement, definitely trending in the right direction, but they've got $8 million in cash left. And it'll be close. It'll be a close call. So I suspect the market's kind of gone, okay, seems encouraging, but you're going to be pretty close to the wire here. So I think if they can avoid a raise, if they can maintain the top line, in fact, even if you just run rate the new ARR wins of the year, that should be 15% for the current year. So if they can sort of get that or better while having a more reasonable cost base, we know that things move pretty dramatically around the inflection point. That's the potential here. So it could be dirt cheap, but there's legitimate question marks over whether that'll happen. I think that's why at this point the market's like, we're still not convinced. I'm going to speak to Jason Cooper, the CEO, tomorrow as part of what we do with Strawman. So hoping to get a bit more clarity there.
Yeah. Nice. Yeah, I think the inflection point can be, it's probably not really an Envirosuite thing, but the challenge can be some businesses really explode. There's just huge operating leverage when you get past that inflection point, but some others aren't. I think it's something to like try and separate out. There's some businesses where they get past it, but it's still a pretty hard slog after that, just because I'm thinking of another one in mind, but there's just a lot of sales work. It's just a slow sales cycle, etc. It's still expensive to grow, basically. Whereas you had others like, Xero, when it first tipped past it, was fairly quick to move move past some of those businesses where there's that faster or shorter, lower, what would I say, like lower overhead sales cycle where, maybe self-serve selling or something like that, or in Xero's case, using a network of
Surprising
others.
how big it can be, right? The growth.
Yeah,
You go, wait a
exactly.
sec, this is even when they have an E, it's like, it's on a PE of 180. I was like, yeah, but that's going to grow, like, it's incredibly low base. Like you go from 0.1 million to like
70.
5 million. It's a big difference.
Yeah, 100%. I think that's just something to be careful of with small caps in general, is often there's a lot of like tech companies, smaller tech companies, in a trap that I've fallen before, where they are technology, but they're not like a pure super high gross margin self-serve SaaS or something, they're
You got to go out and you got to win those deals.
Yeah, exactly.
You got to implement them. There's hardware componentry. Yes. And so I think that's, it's kind of, dare I make the comparison, but it's a little bit like Catapult. Back in the day, it's like, God, you guys with your wearables, you had such a cool little technology, such incredible top line growth, such a big opportunity. And what did you do? It went all to your head and you invested in all these other stupid, maybe that'll prove out in the fullness of time, but you lost focus. You bulked up costs, and it did shareholders no favor. Again, I've said it repeatedly with Envirosuite. It's like, what the hell? Like, just focus on that. They used to be an engineering consulting services firm. They developed this tech in-house. It was really good. Let's just go all in on that. If they had done nothing other than just that and focused in their defined niche, I think that I think shareholders would have done much, much better than what they have done today. But again, it goes to management's head. They get a bit of success, a bit of empire building. So my hope is that there's a little bit of quiet reflection and recognition of that, because as I say, somewhere here, there's a really nice little business and it's a much cheaper opportunity than it was. But as I say, I'll speak to Jason tomorrow, form a more firm conclusion, but it's I'm losing patience.
So you're doing a straw man interview tomorrow?
Yeah.
Nice.
And Playside, actually, Jerry Sakis is coming back. So
there you go.
Keen to chat to him.
High energy Jerry. That should be fun.
Yeah.
I think Playside, we're recording this on Wednesday, they report tomorrow, so we won't cover their ones. But yeah, or maybe on Friday, actually. Anyway, moving on. Another one that we've followed, I don't want to hear the story about how you bought it or sold it or whatever and how much money you would have made, because I hear that every time. We've all got the same story.
If I wasn't such an idiot, I'd be a great investor, is the bottom line.
Objective Corp. What did you check in on this one? So Objective Corp is what, government software, what would you call it?
Enterprise sort of grade software built specifically for government.
Yeah. There's a lot to like about that, right? Super sticky, not necessarily as discretionary, I don't know, as savvy maybe as corporate. Less, can be less shopping for a bargain once you're entrenched, I think. Although you have the swings and roundabouts of government to deal with as well. Yeah, but that got hit pretty hard on results. And also just some interesting stuff where there's going to be a change in the capitalization approach. I think a lot of people were kind of unhappy about that on Twitter, where basically going forward, previously they've been expensing all R&D software development and everything.
So basically free cash flow equaled net profit, broadly.
And maybe just to unpack that for anyone not so super familiar or not grumbling on Twitter about it. Basically, there's two ways that you can treat that type of spending. One is to expense it. So each year when you spend $10 million in R&D or however much you spend, you just recognize an expense that year, it hits your profit and that's done. The other way is to capitalize it. So you don't recognize it as an expense. You show a higher profit in the current year, and then you build up this intangible asset that then needs to be amortized or recognized in future years.
Not necessarily unreasonable. If you've spent $10 million and you build a bit of software that will deliver value and cash flows for another 10 years, then that's a perfectly valid thing. The trouble with it, of course, is it does lead a lot of discretion. There you have to estimate the useful life value of this. And if anyone who's ever had anything to do with software knows, it's never built. Like it's never finished, right? So I think that it's just from a pure look, you can debate the theory, but I think from a pure clarity standpoint and a conservatism standpoint, Objective Corp was just the gold standard. Like we're just going to do it. And I thought it's a shame. What I was going to ask you, Matt, is that the Tony Walls, great capital allocator, by the way, founder, still owns a huge amount of shares, done such an amazing job. But he said he was forced to do it by the auditors. And I kind of thought, Can they do that? How can they force you to do it?
Yeah, I mean, it's a good question. Often he did seem to be pretty adamant, as I understand on the call. Yeah, so the argument was that because they've moved to being subscription only, they have to recognize it this way. There is some, IFRS accounting standards about about revenue recognition broadly, basically. And so certain things have to be recognized, and that goes for capitalization as well. I don't know how much on the forced. I mean, he was pretty emphatic about it, so maybe it was. It is also something that you often hear when they just choose to and say, "Oh, the auditor wanted me to do it."
So, you gotta have a bad guy, right?
Yeah, but I think it is. I mean, in defense of what he's saying, it could very well be the case because it is the standard that everyone else that audit is using, because a very large number of other SaaS companies use that same method of capitalizing these costs to recognize the fact that because you're charging a subscription, it's over time. You're not making these one-time sales, so therefore you should match your recognition of that investment to the revenue. So yeah, I need to dig into the IFRS accounting standards if I have probably haven't done that so far in this earnings season of back-to-back meetings with companies. But yeah, there could be something in there to give him. I won't say that he's wrong or over-egging it there, but it does. The net result of it all is that reported profits should rise next year simply as a result of that capitalization change.
Yeah, less expenses.
Which I don't know. You'd think the market should be smart enough to look through that and not recognize that as what's driven the result. But, next year rolls around and suddenly it's like, whoa, huge gain in profit. Look at this amazing company. Yeah, people forget that there was an accounting change very easily, no matter how much we talk about it now. So
it was a bit of a tricky result. I mean, I thought they flagged it pretty well that the result was going to be less than spectacular. It was only 4% earnings growth and profit was flat, right? So a business that's had very remarkable growth.
4% revenue growth.
Yeah. And then again, there's a whole bunch of reasons for that. There's also a tax adjustment in there. I think I'm going to give Claude a shout out because they did a good piece right up on A Rich Life and sort of came up with a hypothetical PE ratio, sort of trying to adjust for all of these things that we're talking about. It's still at 50.
Yeah.
Which
for no growth is normally would be obscene, right? If it wasn't Objective Corp and all the other stuff that we like about it. If you looked at a no growth company, you'd say that's extremely high.
Very high. Now that's no growth this year, and I think the expectation is actually they will return to growth.
Mm-hmm.
And I think that's a reasonable kind of thing. But let's not forget. I mean, these guys are at $21 in late 2021. Now it's $12 as well. And I know a lot of people I know some people at the time were saying it's very high, but when you account for the capitalization effect and it's actually not as high. It's like, yeah, but it's still high. I mean, it's still up there, right?
Yeah.
And I'm it's really facetious of me to do that because, I mean, a lot of stuff has fallen since late 2021.
Yeah.
But I guess I would say probably got to get over myself a little bit with some of these valuation on high quality companies. It's something that's really done me a disservice, but definitely on the watch list, man. Like it's a cracking company. I can't imagine government getting smaller anytime soon. There's a hell of a lot of modernization that is required there. They have an incredible foothold. There's wonderful opportunity to expand. I think it's I just think it's a fantastic company. And so I won't do what you asked me to do, which is regret and the rest of it. But it is definitely on a watch list. And if I can be a little less fussy, I wouldn't mind owning it at some point.
Yeah, no, I agree. I think it's a really interesting one. Keep in mind when you look at the next results that there's that capitalization change. But even saying that, yeah, very high quality company, we'll see. It was already flagged as being a tougher period for a bunch of other operational reasons. So see if that rolls on through. Cool. All right. What else? Did you have a look at Audinate's results, Andrew?
Not closely. Again, just, there's a lot of baggage there, Matt, which I won't regale you with. And
another one that you bought and sold. You're just like damaged goods for the whole ASX.
I am just the best. I am the best at selling multi-year multi-baggers. I'm really good at that. But yeah, I was like, I don't know what is there to say here other than another kind of wow. Desperately sort of scrolling here.
No, it's a very strong result. Shares are up a fair bit. I don't know if we have to have too much more to say. We'd covered it before.
Just that video's going well, right? That was the big sort of thing. And that's wow. They're getting to a stage in video where it took them a lot longer to get to on audio. And I think that's a big part of it. Any other take or explanations for it, do you think?
I guess that there had been this backlog in chips for Audinate. And I should disclose we own Audinate. So a backlog in chips during the pandemic have been worked through. So this last half, you could say was, well, yeah, it was very strong because they're catching up on that backlog. But their management are also saying like that's not a one-time thing. Like we'll keep growing from here. So yeah, I think that they had been constrained, maybe that's a better way to frame it, on how much volume they could do previously, and that's starting to flow through and that bottleneck being relieved. But yeah, no, very strong. They're they're kind of like a merger of hardware and software, but in a better way, I guess, than some of these other hardware companies we talk about, right? Because their hardware, a lot of it is more licensed. And then they're selling more high margin software on top of that. Yeah, no, a very high quality company, not cheap at today's prices. You have to assume a fair bit of continued growth, but it is one of the most dominant kind of business models that we have on the ASX, where it is literally a standard of interoperability and devices, which is very hard to find because people don't like to allow those to exist in private companies' hands. Yeah,
for me, it's another reminder that the real opportunities I feel come along whenever you see an industry undergoing a structural change. Like this classic PME, paramedics we talk about all the time. I think that's a wonderful example, but so is Audinate, right? Like when the world changing to a digital standard, it's like that can happen fast, and that is an immense market. And whether it's sort of Amazon going and e-retail taking off or whatever it is, like companies can be very efficient operators and they can have great business models and some cool products that are a bit better than the competition. But when a new way of doing something or a new product or service that didn't exist before comes along, like they're the ones I'm saying this out loud for my own sake more than anything else. They're the ones that you just don't overthink too hard because that can run hard and it can run a long way. Obviously, it needs to be managed well. Yeah. But I think in the case of Audinate and Altium,
it does feel like we're in this time where the animal spirits are back, right? Like where a lot of people are like never sell that thing in 2020, 2021. Yeah. I don't know, man. What do you think? Do you think we're back in like a bull market? People are just forgetting about the downside. Do we just?
I think it's a more discerning bull. So the last bull market was just anything, right? Anything with top line growth, we're on board, right?
Yeah.
But the ones that this earnings season have said that, okay, we can have a debate about the valuations, but you can't have a debate about the business quality. I think that's the distinction. And maybe Envirosuite, come back to that as a good example of it. It's sort of like, some notionally good results, but I mean, they're not saying or demonstrating the same kind of things that these other guys are.
That's a good point, Andrew, because there's other businesses that are just getting smashed on results, right? Envirosuite a little down, but maybe another one, Data3, that got hit really hard.
Yes.
And that, wasn't actually, much of a miss versus what people had been, versus what they'd guided and what had been, ostensibly expected. But yeah, it took a big hit on that. I don't know did you look at that one much at all? Had you followed Data3?
Oh God, I've got so much catching up to do. No, I did a bit of convo on Strawman. I did notice the drop. Again, I'll put that in context for people. 750 odd down to 611. Bounced back a little bit today, but geez, that is a huge move.
And it's still growing profit 20%. Like there's, on the face of it doesn't look like too negative, but I guess again, just expectations had run ahead of itself and outlook wasn't as positive as people had hoped.
But was it that different? Was it that, like, to come back to the efficiency side of things? Was it like, oh my gosh, this is really bleak, where I just thought it was going to be a little bit bleak, or not as? I mean, what?
I'm not sure. I can't speak. I can't speak to the people that were dumping it or freaking out. But yeah, there's I don't know. I just see these. It does seem to be the moves lately. It's like if something gets hit, it tends to just really get hit. There's like people aren't wanting to stay around in things that they don't think have the potential to upgrade and continue the, positive news momentum for a while.
Yeah. And it probably was at a reasonably lofty valuation prior to results. So it's a question of, was it something that needed to come down a little? Well, now with not that the outlook was disastrous, but maybe there was an implicit expectation of an outperformance and even better than expected. And when it comes slightly south of that, it's all. And then I think you also get a lot of self-fulfilling prophecies here, like things start dumping, and so people dump, there's a lot of that too.
Yeah, no, for sure. Another one that was down was ARB Group. I don't know if you had a look at that at all. This is the kind of bull bar and, four-wheel drive accessory company. Have you followed that one much lately?
Way back in the Team Invest days, that was one of the big stocks they liked quite a lot. And not without reason. I think it's really one of the unsung heroes. It was one of these companies, actually Objective Corp's another example of this, that actually was just kicking goals for years, like ages. I don't know, I want to say 3-5 years, I'm like, oh, this is more than just a lucky period, like really, and it just under the radar. And there was a lot of sort of private investors that was just like singing the praises, but just couldn't get a buy-in. Like no one was interested in it. It's like, yeah. And then it re-rates, right? And this was ARB, this is Objective Corp, and you get the ongoing strength of the business, which has been unquestionable, but you get that massive multiple expansion. So that happened with ARB. ARB got above $50, I want to say a couple of years ago. And this is another one like Objective Corp, founder-led. I love the REM report based, by the way, on ARB. Like they pay themselves a pittance. I mean, don't feel too sorry for them because they get like absolute king's ransom in dividends each year. But they don't do any of this nonsense. It's just basically, look, there's no LTIs, there's no STIs, none of this nonsense. It's just like we get dividends and we own a crap ton of shares. And so that's our incentive, which I just love, by the way. But no, I haven't looked, no, long run up there. I have not looked closely. Do you have any thoughts?
Yeah, I mean, it's a tricky, I guess there's two kind of paths from here. So net profit was down 27%. And they called out a margin kind of crunch from some delays in passing on cost inflation that had.
Oh, yeah.
Then there's kind of another picture. It's in someone posted on Twitter. Apologies, I've forgotten who it was or where I saw the chart, but just kind of pointing out that this might have just been a COVID winner and the kind of NPAT, needs to revert back to more normal levels as people are doing, people basically bought up a lot more off, outdoorsy type stuff, I guess would be the simplest way of saying it. And the demand for like vehicles and, new purchases and that kind of thing. Maybe that mean reverts and then you need to see it swing to the other direction. So I guess if it swings the other direction, it's probably still quite expensive. If that was genuinely just a one-off, then, I mean, it's not cheap, but it's a very high quality. It's been a very high quality business, has compounded for a long time. It's one that like strikes me, whenever you look at it, like it's just kind of surprising, like how well it's done in a way. Like when you first hear about like a 4-wheel drive accessory, it sounds really commoditized, right?
Yeah, right. Yeah.
You don't think that should be that exceptional, but yeah, just a few small edges I think can make quite a big difference over time and seem to have a good management team.
You nailed it there, man. I'm not a 4-wheel driver, not a car head at all, in fact. But as I understand it, like this is the good kit, right? Like if you're going to get something, you get this, and it's another reminder for me that particularly on anything retail, you are bargain. Oh, you are premium. Like don't be in the middle of the retail spectrum because you get there's always someone who's cheaper or someone who's better than you.
Yeah.
And they have really just been hyper focused on we make the really good stuff. And when we do that, we can afford to get a decent margin and ask a different price. I always say, if you go into a Bentley dealership and ask how much, the price is more than you can afford, right? And it's not to that extent with these guys, but that is their focus. And I think, look, let's just call out the COVID
benefit bump.
A benefit, yes, thank you, is a good one here. If you just look at FY 2020 to FY 23, and I guess they invite you to make that comparison in their chart. That is a 50% increase. So on a compound annual growth basis, like over the last 3 years, it's still incredibly strong.
Yeah.
It's just a good example potentially of above average growth that was extrapolated, and there was top of the cycle kind, if that's the right term for it, earnings having top of the cycle multiples applied to it.
Yeah, fair enough. Just one other distinction I'd make. I think it's a good point you made of wanting to be premium or cheap, and I think it's particularly the case in this market. And I'd kind of differentiate it from other kind of fashion-based markets where this is more like performance versus luxury. So, and the reason it's relevant, I think, is what they sell is like off-road vehicles where you're going out into a remote area, it's dangerous. You can just get stuck out there. If you go off-roading in Australia, like there's points where you won't see another person for a day, right? Like if you go out into like not even off-roading, just on the roads and get stuck in like some of the back roads. And so in that environment, you're willing to pay for something that performs. You'd be willing to pay twice as much easily, right? For something that you don't have to worry about breaking down. And so I think that's true. I think I saw something similar when I did some like sailing racing back when I lived in Denmark, where it was like we'd do like a 50-hour sail race or something. And you think in that environment, you don't want to get the cheap rope or knife or sail jacket or whatever, right? You want the one that actually keeps you dry, actually does whatever. Yes. And it doesn't really matter that like if you go to a marine, like the price of some of these things is like, whoa, that's a lot. But yeah, there's a reason for it. There's like these few firms that, it's very similar actually. There's similar firms to ARB that tend to like make these specific high performance things. So yeah, just another factor.
I will argue, this is becoming more and more of a deeply held belief for me, that it's actually cheaper. Like if you want to
Yeah,
look at
that's a good point.
if I have something that is going to last me 10 years and it's going to work really well, and yeah, it might cost a lot more than the other one, but if I have to replace the other thing every couple of years and I just have a bad experience, like it's a false economy, right? So
if I could pay for a microphone setup that never screwed up on my computer, I would pay for it. Like these little things where they haunt you just as you're about to do something important, right? And I don't know if there is because my microphone plays up plenty of times, but like those things that could betray you in like a clutch moment, I think those are the types of things you just like, it's just not worth it. Have you had a few of those? You strike me as a guy who's like pushed the push the boundaries of paying not too much and then like regretted it.
I think the first epiphany for me, this probably goes, I mean, I was too late in life to have the epiphany, but I probably had it 15-ish odd, maybe longer years ago. Remember back in the day where you had to wear a suit and you had to go into the, God, I do not miss those days. But I did. And I'd always have some crappy pair of shoes and like they would last a year and I'd replace them. And people always say, oh, get some RM Williams. Like, I remember, again, I can't pick the year because I'm old and senile, but it was like $400 like back then. So I mean, inflation adjusted, that was a crap load of money for some shoes. I've still got them. They still look brand new. I've had them resold a couple of times. And yet, I think how cheap were those boots, and I've actually, because now I talk every time I see someone else wearing, you have that conversation with them. And I actually met someone a while ago. I was like, oh, these are my dad's. It's like, what? No way. Like, yeah, that is, I think things like beds, I'm big on, I've got a really good bed, but I bought it yonks ago. I'm like, well, I literally spend a third of my life on this thing. And, I value my sleep. Am I really going to try and save 20%? And like when you fractionalize the cost, like what is my cost per sleep? It's going to end up being, 0.001 cent as opposed to, 0.0001. So, what's the difference, right? Like get the good thing.
This week's episode brought to you by RM Williams, established 1932 in Australia.
There you go.
Get him a gift he'll treasure this Father's Day. We're not actually sponsored. We don't.
I think K. Rudd gave Obama a pair, didn't he?
He did.
Like a gift.
Yeah. Did someone give an Akuba to someone or something as well? It feels
another
like
good example.
Kind of
Yeah.
Anything else catch your eye this earnings season, Andrew? Maybe otherwise we'll.
Oh, look, there is so much to talk about, so we're not going to do it justice, and it's going to take a bit of time to digest. I guess some closing thoughts would be, we've touched on this, is that this is really I hate the term, but the stock pickers market. There is always, I'm always reminded about this, no matter how gloomy or attractive or sexy things look, there's always risks and there's always opportunities. I feel you just have to be a bit pickier now, but we are seeing that there are some great things and opportunities out there. I think the other thing it's worth remembering, again, I'm saying this for my sake more than anyone else's, is that it comes at you fast, right? And you're drinking from the fire hose and you're doing it in the context of watching a market react to that. And I feel as though, don't rush it. Wait till you take the time. Like it could be 3 weeks from now, right? Like you still be going through they'll still be fresh. They'll still be reasonable. A lot of that, quick hot money will have come and gone potentially by then. I don't know. I just feel as though I never like to be in a situation where I feel as though I'm forced to act because the results now, and there's 10 results and I've got to cover them all today. And I've got to do this. And oh my gosh, the share price is up. And if I don't act now, I'm going to miss it. I think that is bad thinking. So just take your time with it. We'll have 6 months between now and the next set. So, take it easy.
Yeah, no, 2 really good bits of advice. I think we talk about macro sometimes on here because we want to make sure we have something to talk about each week.
Sure. And it's interesting though, right?
Yeah, it's interesting. But the main thing is to find these companies, right? That you can find companies that perform in all markets because there's always something, doing well. There's something business that's growing, the economy is driving forward. And your other point, I think, it's so easy when results are out to look at the share price to figure out what's going on. And it's such a bad idea to do that. The way to do it as much as you can, it depends when companies report. Sometimes it's harder, but just don't look at how the stock's doing. You're not going to be day trading it, right? You're probably not going to be just do your own work on it first, right? Like look at the results. How does that compare to what you expected? Maybe listen to the earnings call, think about it. And maybe you think, oh, that's a really good result. And then go check what the market's doing. Maybe the market will even be down and you could have that can be a really good opportunity. Other times it might be up a little, etc. But if you just go to the market first, everything else you see will be colored by that first perception. And as we've seen with that, you mentioned some stocks where the market goes up and goes down. It takes time for everything to process and flow through. And again, to your other point, just keep working on it. We'll probably still be talking about this earnings season. Some stuff we pick up, several weeks from now. There's still plenty of time to respond to what's happening.
Can I give another observation is that this is always, it feels like it's very rare that you find that investment which just goes up steadily year after year, half on half. It just doesn't doesn't happen. It's always this gradually then suddenly. And that's testing, right? Imagine the dude that bought, I don't know, Altium in mid 2019, $35. You were up a little bit at some points, you were down a little bit at some point. That is a long time, 4.5 years. And then, I mean, the average, I mean, who knows what happens to the share price tomorrow? But my point is that's usually the way, I think, with investing, where it's sort of like the gain, the CAGR will be attractive on the ones that work out, but it's not as though that's like that is no bearing on reality. You never had that that was not your average growth not the growth you experienced each year is what I'm trying to say.
Yeah.
It's probably, and you'll
up and oh, this is really good. Oh, this is terrible. Yeah.
And the demons come is like, oh man, the market's racing ahead. I've been holding this thing for 3 bloody years. Nothing's happened. Stuff it, I'm out. And then it's the day after that it rallies 25% or something like that. It's always the way. So as long as that thesis is in play, don't do a damn thing, right? Like just don't. And notice that we all say it's sort of like, oh, short-term voting and long-term weighing. We pull out the Buffett quotes. It's like, no, own that, right? Because it may be a weighing machine eventually, but it's gonna be a tough wait, And I really try to internalize that.
Very good. Very good advice. I like that. Strong way to close. Let's call it there. Have you had anything that you found interesting? Hit us up on Twitter @BabyGiantsPod, and we can chat about it next week. Till next time, thanks very much for listening.
Yeah, thanks for listening.